DePIN, which stands for Decentralized Physical Infrastructure Networks, represents one of the most concrete value propositions in the broader crypto ecosystem. Unlike many crypto categories that operate purely in digital domains, DePIN projects use token incentives to bootstrap the deployment of real-world physical infrastructure. Wireless network coverage, distributed storage capacity, GPU compute resources, environmental monitoring sensors, road mapping data, and many others. The combined market capitalization of the DePIN sector exceeds $45 billion in 2026, with projects spanning multiple infrastructure categories and varying levels of demonstrated real-world utility. For institutional allocators, the analytical question is which DePIN projects have actually delivered measurable infrastructure at scale and which remain primarily token speculation with limited real-world deployment. The category is one of the few in crypto where infrastructure deployment metrics, physical nodes, storage capacity utilized, coverage area, data collected, can be objectively measured and compared to centralized alternatives. This makes DePIN one of the most analytically tractable crypto sectors for institutional evaluation, provided the analyst is willing to engage with infrastructure deployment data rather than purely tokenomics narratives. Helium and Filecoin represent two different DePIN approaches that have both achieved meaningful infrastructure deployment but face different economic challenges. Helium operates as a decentralized wireless network where node operators deploy hotspot devices that provide low RWAN coverage for IoT devices, 5G coverage for mobile devices, and Wi-Fi hotspot services. The network has scaled to over 1.1 million active hotspots globally, making it one of the largest physical infrastructure deployments in the crypto sector by raw node count. Helium transitioned from its own Layer 1 blockchain to Solana in 2023 to reduce operational costs and improve token economics. The challenge for Helium has been monetization. Despite the substantial physical deployment, the network generated only around $3 million in real revenue during 2025, far below what would be required to justify the infrastructure deployment costs and ongoing operational expenses. The disconnect between deployment scale and revenue raises questions about whether Helium's economic model can sustain the network without continued token subsidies. Filecoin pursues a different infrastructure category: decentralized storage. Storage providers commit hardware capacity to the network and earn FIL tokens for storing client data with cryptographic proofs of storage. The network has accumulated approximately 5 exabytes of committed storage capacity across roughly 3,800 active storage providers, a substantial physical footprint. The key difference from Helium is that Filecoin has demonstrated more institutional traction. Major data archives, scientific repositories, and even some enterprise customers use Filecoin for actual data storage at meaningful scale, with current real storage usage estimated at around 25% of committed capacity. The DePIN sector breaks down into several distinct infrastructure categories, each with different deployment dynamics and economic profiles. The compute category, represented by Render Network and Akash Network, focuses on distributing GPU and general-purpose computing capacity. Render Network at $3.2 billion market cap leads this category with its specialized focus on 3D rendering and AI inference workflows, while Akash Network at $850 million market cap pursues a broader container deployment platform thesis. The storage category, represented by Filecoin and Arweave, addresses different storage use cases. Filecoin at $2.4 billion focuses on flexible duration storage with deletion possibility, while Arweave at $410 million pursues permanent storage with a single upfront payment model. The wireless category, dominated by Helium at $650 million, addresses IoT and consumer wireless coverage. The media delivery category, represented by Theta Network at $580 million, focuses on decentralized video streaming and content delivery network functionality. The mapping category, represented by Hivemapper at $220 million, uses incentivized data collection from drivers to build alternative mapping infrastructure competing with Google Maps. This sector breakdown reveals several patterns relevant to institutional analysis. The compute category has the highest market valuations, likely reflecting both real economic activity and AI narrative tailwinds. The storage category has clearer economic models but slower growth. The wireless and mapping categories face the strongest competition from well-funded centralized incumbents. Institutional evaluation of DePIN projects requires a 4-step framework that distinguishes genuine infrastructure deployment from token-incentivized activity that does not produce real economic value. The first step is physical deployment metrics. This includes the number of nodes actually deployed and operational, the geographic distribution of those nodes, the hardware specifications and capabilities of the deployed infrastructure, and the verification mechanism that ensures claimed deployments correspond to real physical infrastructure. Projects with strong on-chain proof mechanisms, like Filecoin's proofs of storage or Hivemapper's location-validated data submissions, provide more analytically reliable deployment data than projects that rely on operator self-reporting. The second step is real economic activity assessment. This means examining actual usage data, gigabytes of data actually transferred or stored, GPU hours actually consumed, network coverage actually utilized, independent of token issuance. Many DePIN networks have substantial capacity but limited real usage, with most activity being internal to the token economy rather than external paying customers. The ratio of external customer activity to total network activity is a critical metric. The third step is competitive positioning analysis. DePIN projects compete against well-capitalized centralized alternatives, Amazon Web Services for compute and storage, traditional wireless carriers for connectivity, Google Maps for mapping. The institutional question is whether the DePIN project offers meaningful cost or capability advantages in specific use cases. Vague claims of decentralization benefits without concrete cost or capability differentiation are typically not sufficient. The fourth step is token economic sustainability. This examines whether the network can sustain operations and incentivize continued infrastructure deployment without indefinite token subsidies. Networks where token rewards far exceed real revenue generation will eventually face token economy collapse unless real revenue scales meaningfully. Institutional allocators considering DePIN exposure must understand 4 specific risk categories that distinguish this sector from pure digital crypto plays. The first risk is token reward dependency. Most DePIN networks rely heavily on continued token rewards to sustain node operator economics. Real revenue from network usage typically covers only a fraction of operator costs, with token emissions making up the difference. When token prices decline, operator economics can deteriorate rapidly, potentially leading to node deactivation and network capacity reduction. This creates a reflexive dynamic where token price weakness can directly impact infrastructure deployment, which can further weaken the investment case. The second risk is centralized competition. DePIN projects compete against hyperscaler infrastructure providers, primarily Amazon Web Services, Google Cloud, and Microsoft Azure, that have substantially lower costs of capital and the ability to subsidize infrastructure deployment indefinitely to maintain market position. In most general-purpose infrastructure categories, DePIN projects struggle to offer compelling cost advantages over centralized alternatives. The exceptions tend to be specific use cases where decentralization offers genuine functional value, censorship resistance, geographic diversity, regulatory diversity, or specialized workflows. The third risk is the capacity versus usage gap. Network capacity metrics like total storage committed, total compute available, or total wireless coverage often exceed real customer demand by factors of 10 or more. Headline deployment numbers can be misleading about actual utilization. Institutional due diligence should focus on usage data rather than capacity data. The fourth risk is regulatory exposure. Physical infrastructure deployment intersects with various regulatory frameworks, wireless spectrum regulations, data storage compliance requirements, mapping data privacy laws, and others. DePIN projects may face regulatory friction that purely digital crypto projects avoid. The institutional verdict on DePIN follows from a synthesis of the deployment, economic, competitive, and regulatory analysis. 4 conclusions guide appropriate position construction. First, institutional capital should concentrate on the DePIN networks with the most clearly demonstrated deployment and real economic activity. Filecoin, Render Network, and Helium offer the most analytically tractable cases with verifiable infrastructure deployment that can be independently confirmed. Smaller projects in the long tail of the DePIN sector frequently have unverified deployment claims and limited transparency, making institutional due diligence cost prohibitive relative to expected position sizes. Second, the most important analytical metric for DePIN evaluation is real customer usage rather than total network capacity. A network with 5 exabytes of storage capacity but only 25% utilization is a different investment proposition than a network with 1 exabyte of capacity at 90% utilization. Institutional analysts should focus on the usage side of the equation and treat capacity as context rather than primary signal. Third, token economic sustainability deserves explicit attention. Networks where annual token emissions exceed annual real revenue generation by large factors will face economic challenges if external token demand declines. Token economic models should be evaluated for their path toward equilibrium between revenue and emissions, not just their current emission rates. Fourth, DePIN exposure should be sized according to infrastructure venture investment principles. The time horizons for meaningful infrastructure deployment and revenue scaling are measured in years to decades, not months. Institutional positions should reflect this with patient capital allocations and acceptance that infrastructure-scale economic value creation moves slowly even when token markets move quickly. DePIN represents one of the most analytically tractable crypto sectors for institutional evaluation because the infrastructure deployment metrics can be objectively measured and compared to centralized alternatives. The challenge is doing the analytical work to distinguish projects with real deployment and usage from projects whose apparent activity is driven primarily by token incentives that cannot sustain at scale. Subscribe to Crypto Mechanics for ongoing rigorous evaluation of crypto infrastructure projects, including DePIN deployment metrics, economic sustainability analysis, and competitive positioning versus centralized alternatives. We publish weekly institutional research covering the protocols, projects, and structures that determine institutional digital asset allocation outcomes. Thank you for watching.